Hi there, welcome back to ET Now. You're watching this very special edition of IPO Central First Up. And today we are in conversation with Anish Reddy Bodu, who's the Managing Director and Chief Executive Officer, as well as Anant Chaubey, who's the Chief Financial Officer and Chief Operating Officer as well of Capillary Technologies India. They're all set for their IPO. And let me start with you, Anish. Many congratulations first up. And, Capillary is now stepping into this listed space. So tell us, what's the big picture vision you're working on towards the next 3 to 5 years?
At Capillary, we want to build the best loyalty management company globally. That's been our goal for many years now. And if you want to build the best company in this space, then you want to get to a 10% of the world's largest or the Fortune 500 companies working with you. Today, we work with 19 of the Fortune 500. You want to get to best-in-class margins, best-in-class growth as a business. If you look at us, we've grown roughly about 70% CAGR over the last few years. Our margins have been 10% plus on the EBITDA margin side and growing very well. We hope to continue on this path in building a product leader out of India.
Right. Anant, you've positioned yourself as an AI-driven SaaS company with a strong global presence. Where do you see the biggest growth opportunity in expanding existing enterprise accounts or tapping new geographies or verticals?
So a part of our growth comes from winning new logos, and we try and win one Fortune 500 customer every quarter. We have about 19 Fortune 500 customers on board now. When we filed the RHP, it was actually 16. So we are consistently growing by expanding with newer logos that we are working with. At the same time, a part of or majority of our growth comes from expanding with existing customers. So our existing customers grow by about 15% every year, which is a more profitable and sustainable way of growing for us. So both existing customers as well as new customers. The third lever of growth for us is actually acquisition of other loyalty companies. We have done 4 loyalty companies acquisitions over the last 4 years, and we acquired loyalty logos and migrate customers from a low gross margin profile to Capillary Technologies with a high margin profile, and that's where we make money. So growth comes from combination of all of these three for us.
All right, so that's the kind of growth you're looking at. But, like you mentioned, Anish, about acquisitions, a large portion of your proceeds is earmarked for unidentified acquisitions. So tell us, what are the kind of targets or capabilities that you're scouting for? Is it mostly tech-led or customer accretive, or any special geographies that you could tell us that you're looking to expand into?
We typically tend to acquire other loyalty companies. So if you look at us, we have the best product globally in the space. Pick any analyst report, Forrester, Everest, you will see us in the top 2. So our acquisitions over the last few years and in the near future would be focused on buying books of business, which we can then migrate onto our platform. We've done 4 of these acquisitions in the last 4 years. So these are typically low margin, services heavy, agency like businesses that run at a 15% type gross margin. Once we migrate those customers over onto our platform, it ends up getting to a 60-70% gross margin, and that is what funds the acquisition, right? This 40% plus growth in margins. And given this thesis, we are agnostic to acquiring companies in the US or Europe or anywhere else in the world, as long as they are in the space of loyalty, as long as it's businesses that we can acquire at 0.5 to 1.5 times revenue multiple, because at that math, and after the migration, the economics work well for us. It's typically a 3 to 5 year payback. All of those maths work well for a profile of company in the space.
Anish, your R&D and product design spend is substantial. What are the key innovation areas or new platforms that will drive the next leg of growth?
In terms of product, we are a product company, right? So if you want to build a market-leading product that analysts love, you'll have to invest in tech. We spend roughly about 20% of our revenues on technology, and that investments make sure that pick any analyst report on loyalty globally. You will see us in the top 2, right? We also have like 19 of the Fortune 500, which is again a testament to the quality of the product. In terms of investments, we're doing a lot of investments on the AI side. We do believe that software and services are going through a very big transformation thanks to Gen AI and even machine learning and some of the non-Gen AI side of AI. There's a lot of investment that's happening on that. What we're also doing is deepening the product on vertical specific use cases for loyalty. We pick 1 or 2 verticals every year, build a deep product for it, because we believe that in an AI first world, it's the depth of functionality that will help you win more, right? So those 2 are the big themes, verticalization and AI, where a lot of our product investments are going.
All right, so that's about investments, especially AI. But Anand, how soon do you think the IPO proceeds will translate into top line or profitability gains? If you could, shed some light over there.
We have planned for IPO proceeds to be used over the next few years. A part of the IPO proceeds are towards R&D, and a lot of these investments would be going through building AI products, and that would happen over the next few years. There are some parts of these proceeds which are unidentified. Part of those can be used for future M&As and others. But we expect over 3 to 5 years to use some of these IPO proceeds on both R&D, product development, and acquisitions.
Right. Anish, lastly, what kind of revenue growth are you targeting over the next 2 to 3 years? And can you give us a sense of the expected growth trajectory post the IPO?
Right. So if you look at our last few halves or years of growth, our H1 FY25 and H1 FY26 numbers are published in the RHP. We've grown at about 25% on revenue between the first half last year to the first half this year. In terms of EBIT margins and net profit margins, there's been a 400 basis point growth from last H1 to this H1. I think we do think that we'll continue to grow at that clip. It's a very large market. There's lots of leverage in terms of revenues flowing down to the bottom line in the business. It's a high gross margin business. So we do think that we can continue to deliver similar rates of growth, both on the revenue and the profitability side for the next few years.
All right. Thank you, Anish and Anand, for joining us today and taking us through that entire outlook of what you plan to do with the IPO proceeds as well as your business outlook going forward. On that note, we'll let you go. Thank you so much for joining us today. Well, with that, it's also time to take a very short break. We'll be right back with more top buzzers in trade today. So stay tuned to ET Now.